Imagine holding a smartphone app, right? One that just seamlessly processed nearly $100 billion in wealth for its users.
Oh, yeah.
But then, the physical shopping mall right down your street is just bleeding cash, barely keeping the lights on. We are really watching a real-time structural split in how our economy actually operates.
It's a brutal dichotomy, honestly.
Right. And if you want to understand the modern consumer, especially the younger generation, you don't look at what they say in surveys. You look at the friction they tolerate in the physical world, and you look at where they instantly park their paycheck in the digital one.
Exactly. We're witnessing two completely different economic realities playing out at the exact same time, and they're driven by the exact same demographic, which is wild. The shift from physical experiences to digital financial habits is, well, it's rewriting corporate survival strategies from the ground up.
Which brings us to our mission for today's deep dive. We are tearing into two highly contrasting Q1 2026 financial reports just to understand exactly how digital natives, so millennials and Gen Z, are spending, saving, and forcing legacy companies to adapt.
Right.
So we've got the Q1 2026 SEC Form 10Q for Zumiez, which is the classic mall-based action sports and streetwear retailer, and we are pairing that directly against the fiscal Q1 2027 earnings release for Wealthfront, the newly public tech-driven financial platform.
The contrast there couldn't be sharper. I mean, you've got a legacy retail brand hustling to sell physical lifestyle apparel to teens in brick-and-mortar malls, all while battling global supply chains.
Yeah.
Then you flip the script and you have a digital-first platform automating how those same demographics build long-term wealth entirely through the screens in their pockets.
Okay, so let's unpack this. Let's start with the physical world and see where these younger consumers are actually dropping their discretionary cash before we look at how they save it digitally. I was digging into Zumiez's Q1 results. This is for the quarter that ended May 2, 2026. And honestly, the top-line revenue numbers look surprisingly solid.
They really do.
Right. Net sales actually rose 4.9% to $193.3 million. Their comparable sales were up 4%. They saw genuine growth driven by men's and women's clothing, accessories, hard goods. The only real soft spot in the actual product categories was a dip in footwear.
Yeah, and those top-line metrics definitely suggest the consumer hasn't abandoned the brand. I mean, they're still showing up. They're still willing to spend money on self-expression and physical lifestyle goods.
But here's where I have to push back, or at least point out what looks like a massive contradiction in their own filing.
Okay, let's hear it.
If their sales are up almost 5% and they're moving more merchandise, why is Zumiez still posting a $13.3 million net loss for the quarter?
Right, it's a huge hit.
It's like running a lemonade stand where you're selling more cups than ever, but the cost of the lemons, the cups, and the rent for the sidewalk is eating literally every penny of your profit. You're grinding harder just to burn cash.
What's fascinating here is the sheer mechanics of a modern retail loss. It's not just about designing cool clothes anymore, It's about the friction of existing in the physical world.
Yeah.
When you read the macroeconomic headwinds detailed in their 10Q, the operational realities are just intense. First, you have to look at their heavy reliance on mall foot traffic.
Which they don't even control.
Exactly.
Yeah.
A brand like Zumiez can't control how many people walk past their storefront. They rely entirely on the mall's anchor tenants to generate that gravity.
And if those massive department stores at the ends of the mall are struggling to pull people in from the parking lot, your foot traffic craters. But your lease agreement certainly doesn't care. The rent is still due.
And rent is just the local problem, right? When you look at their 10Q, the real bleeding is happening on a global scale.
Oh, right, the supply chain stuff.
Exactly. Most of their merchandise is manufactured abroad, including a massive historical reliance on China. That exposes them to wild swings in foreign currency exchange rates and the constant, unpredictable threat of international tariffs.
Which fundamentally breaks their supply chain, right? Because if a tariff gets slapped on a specific fabric or product category, it doesn't just bump the price up a few cents.
Far from it. I mean, it forces the company to completely re-engineer how they get products to the shelf. They have to map out new factories in, say, Vietnam or Mexico.
Wow.
They have to establish entirely new quality assurance protocols, secure new shipping routes, and negotiate new freight contracts. The friction of just moving a skateboard or a hoodie across the ocean has become incredibly capital intensive.
And even after they pay all those premiums to get the hoodie into the country, the cost to actually physically hand it to the customer is skyrocketing.
Oh, the labor costs.
Yeah. They have a massive physical footprint, which means thousands of store associates whose wages are tied to a patchwork of federal, state, and city minimum wage hikes. If Seattle hikes its minimum wage, but a suburb in Ohio doesn't, it becomes nearly impossible to just universally raise the price of a t-shirt to cover those hyper-local costs. The infrastructure of physical retail is just suffocating under its own weight.
Which is why the silver lining in this report is actually so impressive.
Oh.
Yeah, they are just letting those costs run wild. Despite the overall net loss, Zumiez managed to improve their gross profit margin by 170 basis points.
Hold on, for the uninitiated, 170 basis points, we're talking about a 1.7% improvement on their margin, right?
Exactly. 100 basis points equals 1%. So bringing their gross margin up to 31.7% in this environment is a significant operational victory.
How are they pulling a 1.7% efficiency gain out of thin air while battling all those headwinds?
Well, they engineered it through a few distinct channels. They realized 50 basis points, or 0.5% of leverage in store occupancy costs.
So just better stores.
Basically, yeah.
Yeah.
By generating higher sales out of fewer, better performing stores,
Right.
their overall rent burden became a slightly lighter percentage of their revenue. But the real margin improvement came through negotiating lower web shipping costs and successfully decreasing their inventory shrinkage.
Shrinkage, the retail industry's polite cover word for theft, damaged goods, or inventory that just vanishes off the truck.
That's the one.
I used to think of shrinkage like a leaky bucket, but honestly, in 2026, it's more like cloud computing egress fees. You're paying to store all this inventory, but every time someone extracts it out the back door without paying, you get hit with a massive invisible tax. What Zumiez is proving here is that patching even a few of those extraction loopholes saves millions of dollars at scale.
It's a critical point for you listening. When you walk into a store today, the price you see on the tag has very little to do with the actual fabric.
Right.
That price tag is a localized reflection of a highly complex web global freight contracts, unpredictable geopolitical tariffs, localized wage laws, and yes, how much merchandise is walking out the front door unpaid.
Seeing this massive divergence in profit margins based on physical friction is one thing, but if the legacy sector is squeezing margins just to survive, where is the actual momentum? We have to follow this younger demographic out of the physical mall and straight onto their smartphones.
We really do.
We're transitioning from how these digital natives express themselves, buying streetwear at Zumiez, to how they actively turn their cash into wealth. Let's look at Wealthfront.
It is a staggering pivot in business models. Wealthfront's fiscal Q1 2027 earnings, this is for, ended April 30, 2026, showcase metrics that are operating in a completely different universe.
The scale is wild. Total platform assets skyrocketed 19% year over year to a record $96.6 billion.
Almost at $100 billion.
They are quite literally knocking on the door of $100 billion in assets under management. Their revenue hit $90.5 million, up 7%, and they grew their funded client base by 13%, reaching 1.46 million individual users.
The user acquisition alone proves the demographic is aggressively seeking automated digital-first solutions for their capital.
I hear that, but I have to throw a flag on the play here. I'm looking at their bottom line, and there is a massive red flag.
Okay, what do you see?
Revenue is up 7%, sure, but their GAAP net income plummeted by 51%, down to $12.8 million. Their earnings per share dropped from 18 cents a year ago down to just 7 cents. How on earth is a 50% drop in net income considered a victory lap for a newly public company?
That's the exact trap headline readers fall into, honestly. You have to look past the GAAP numbers.
Okay.
So, generally accepted accounting principles, to understand the mechanics of a company that recently went public.
Okay, explain that.
That massive drop in GAAP net income wasn't because the core wealth management business suddenly broke down. It was almost entirely driven by a massive, predictable spike in stock-based compensation expense.
Define massive. How big of a jump are we talking about?
Well, it surged from $1.9 million in the prior year's quarter to $17.1 million this quarter.
Okay, why the sudden $15 million explosion in stock expenses?
It's the result of dual-trigger stock awards tied to their IPO. In the tech and startup world, companies often compensate employees with stock units that have two distinct triggers that must be met before they officially vest and hit the company's income statement as an expense.
Right.
The first trigger is time. You have to work there for, say, 4 years. The second trigger is a liquidity event, specifically an initial public offering.
Ah, I see. So for years, their software engineers and product managers were working, earning these shares on paper. But because the company was private, it wasn't hitting the public income statement.
You've got it. The moment Wealthfront executed their IPO, That second trigger was pulled across the entire company simultaneously. Suddenly, a massive multi-year backlog of compensation expense has to be recognized on the books all at once.
Okay, so it's like finally paying the massive catering and venue bill after hosting a very successful wedding.
It's a great way to look at it.
The wedding was a hit, the marriage, the core business is healthy, but you just had to write this massive one-time check that makes your checking account look terrifying for a brief minute.
That captures the accounting quirk perfectly.
But wait, I'm going to push back on that, because isn't that still a real cost? If I'm an everyday retail investor holding Wealthfront stock, they just flooded the market with millions of newly vested shares for their employees. That dilutes my slice of the pie. It's not just fake paper math, it's real dilution of my ownership.
You're absolutely right to call that out, and dilution is a very real cost to the shareholder. But if our goal is to understand the actual cash-generating health of their daily operations, we have to look at adjusted EBITDA.
Earnings before interest, taxes, depreciation, and amortization.
Exactly. This metric strips out non-cash charges, like that stock-based compensation, to show us the actual cash engine of the business. And Wealthfront's adjusted EBITDA was $37.5 million, operating at a very healthy 41% margin.
So the engine itself is printing money even if the cap table is getting crowded.
Exactly. If we connect this to the bigger picture, the undeniable proof is their adjusted free cash flow, which sat at $42.7 million for just this 3-month period. They are generating immense actual cash. And the deeper story inside this quarter isn't just that overall assets are growing. It's the mechanism of where those assets are moving inside their ecosystem.
Let's get into that, because they basically offer two main buckets: cash management accounts, which act like high-yield savings, and investment advisory accounts, where they actually invest your money in the market.
Right. And for the last couple of years, while interest rates were high, a huge chunk of client money was just sitting idle in those cash management accounts collecting yield. But this quarter, the momentum flipped.
Okay.
Cash management assets only grew 3% year over year to $44.9 billion. Meanwhile, investment advisory assets surged 39% to $51.7 billion.
Which is a massive win for Wealthfront's business model, because they charge different fees depending on where the money sits, don't they?
They do. The report explicitly notes their annualized cash management fee rate was around 0.58%, or 58 basis points, while their investment advisory fee rate was much lower at 0.21%.
Wait, if they make 58 basis points on cash but only 21 basis points on investments, isn't moving money into investments actually hurting their revenue?
In the absolute short term, the fee rate is lower, yes. But driving clients into long-term equities creates ultimate platform stickiness.
Oh, I see.
Yeah, if a user is just parking cash for a 5% yield, the second another app offers 5.1%, they will transfer their money. It's highly transactional. But when a client has their retirement funds algorithmically invested in the market through your app, the psychological and logistical friction to move that portfolio is enormous. They've shifted the relationship from a temporary parking lot to a generational wealth hub.
Watching how these two executive teams play the completely different hands they've been dealt is where the real masterclass begins. How do you allocate capital when your reality is a physical mall brand shrinking its footprint versus a digital fintech aggressively expanding its features?
It's totally different playbooks.
Let's look at Zumia's strategy first. It's essentially addition by subtraction.
It is a purely defensive optimization strategy.
Right. The report notes they closed a net of 16 stores subsequent to May 3, 2025. They are actively looking at their massive legacy portfolio of over 700 stores and ruthlessly pruning the dead weight, ensuring they are only paying rent in optimal high-traffic locations.
And they are systematically cleaning up legacy liabilities that drain cash. For instance, they settled a California wage and hour lawsuit, specifically a PAUG claim for $2.89 million.
Wait, a PAG claim? I see that acronym in the notes, but what exactly is the mechanism there? Why is that costing them nearly $3 million?
The PAUG stands for the Private Attorneys General Act in California. It's a unique legal mechanism where a single employee can sue their employer for state labor code violations, not just for themselves, but on behalf of all aggrieved employees and the state of California.
Oh, wow, that scales fast.
Exactly. So a minor scheduling error, a missed meal break, or a uniform technicality doesn't just result in a small fine. It aggregates into a multi-million-dollar class action style penalty.
Wow. So when you are operating in a low-margin, high-friction physical business, a tiny operational mistake can multiply into a catastrophic cash drain.
Totally.
Capital allocation for Zumia's is literally about plugging these exact types of leaks. You close the bad stores, you settle the aggregation lawsuits to stop the bleeding, and you optimize your existing supply chain.
Now, contrast that defensive posture with Wealthfront. They are sitting on a geyser of free cash flow, and they are playing aggressive, expansive offense. They aren't shrinking at all. They are actively building new products to monopolize more of their customers' financial lives.
The product offensive in this report is wild. They launched general availability of Wealthfront home lending actual mortgages in Colorado and Texas during this quarter.
They aren't just offering mortgages. They are weaponizing their cost structure. They are aiming to offer rates 50 basis points, a full 0.5% below the national average.
Here's where it gets really interesting. How exactly do you underwrite a mortgage 0.5% cheaper than a legacy giant like Chase or Bank of America?
You leverage the exact digital architecture we've been talking about. A traditional bank requires thousands of branch locations, commissioned loan officers, and manual underwriters verifying your W-2s and pay stubs.
Right, huge overhead.
Exactly. Wealthfront has none of that physical overhead.
Mhm.
More importantly, they already have the user's financial data. If your direct deposit and assets are already on their platform, their algorithms can underwrite the risk instantly. They strip out the commission fees and the real estate costs, and they pass those savings directly into the lower interest rate to steal market share.
They're turning their lack of physical friction into a competitive weapon. And the smartest mechanism I saw in the entire report was their new cross-product adoption incentive.
Oh, the APY boost.
Yes, they are offering a 25 basis point APY boost, an extra 0.25% yield on cash, but only for clients who do two specific things. First, set up a direct deposit of at least $1,000 a month, and second, fund an investment account.
Acquiring the user's direct deposit is the holy grail of consumer finance. The moment that paycheck lands natively inside Wealthfront, the friction to invest a portion of it, or save it, or eventually use it to pay a Wealthfront mortgage, drops to absolute zero.
Incredible.
Yeah, that specific incentive drove their asset-weighted cross-product adoption to roughly 62.5% at the end of the quarter. They are literally buying loyalty with yield.
So what does this all mean? We have two companies operating in completely different realities, one playing defense in the mall, the other playing offense in the cloud. But when you look at their cash flow statements, they are executing the exact same maneuver in the stock market.
Right, the buybacks.
Exactly. They're both aggressively buying back their own shares.
It's a brilliant observation
Yeah.
that proves how the exact same financial mechanism can be deployed for entirely different strategic reasons. Let's look at the actual capital deployed.
Okay.
Zoomies bought back 265,000 shares for about $6.2 million, which was part of a newly approved $40 million repurchase program. Wealthfront executed its inaugural share repurchase program, buying back over 3 million shares for more than $27 million.
Why do both of these executive teams, facing completely different problems, view their own stock as the best thing to buy?
Well, for Zoomies, it's a survival signal and a value play. Their stock price has likely been hammered by the exact macro headwinds we discussed, tariffs, wage hikes, mall traffic.
Right.
Management looks at their balance sheet, sees they haven't drawn down any debt on their revolving credit facility, and decides their stock is fundamentally underpriced. Buying it back returns value to the remaining shareholders and signals to the market that they have established a floor. They are confident they can weather the storm.
And what about Wealthfront? They aren't trying to establish a floor.
Exactly. For Wealthfront, the buyback is about managing the consequences of their success. Remember the dilution concern you brought up earlier regarding their massive stock-based compensation?
Right. The IPO triggered millions of new shares, shrinking the retail investors' slice of the pie.
Precisely. They generated $42.7 million in free cash flow in just 3 months. Even after funding their engineering teams, launching the mortgage product, and acquiring new users, they simply have more cash than they can efficiently deploy into operations.
So they just buy up the extra share.
Yeah, so they use that excess cash to buy back shares on the open market, actively neutralizing the dilution they created by paying their employees in stock.
Yeah.
It is the hallmark of a maturing, highly profitable technology ecosystem.
For you listening, whether you are managing your personal household budget or analyzing a publicly traded corporation, the financial physics are surprisingly universal. If your margins are tight and your environment is hostile, you have to aggressively optimize plugging the leaks, cutting the underperforming assets, and betting on your own survival, just like Zumia's. But if you've built a low-friction cash-generating engine, your mandate is to leverage that advantage to cross-sell new products and deepen your moat. Exactly like Wealthfront weaponizing its data to underwrite cheaper mortgages.
You have to adapt your capital allocation to the reality you are actually operating in, not the economic environment you wish existed.
Let's bring this all together. Today, we've unpacked the hidden mechanisms of our two-track economy. We've seen how global supply chain shifts, localized minimum wage hikes, and the brutal overhead of physical real estate are forcing legacy retailers like Zumiez to run incredibly tight defensive playbooks just to maintain their margins.
While in the same quarter, digital-first platforms like Wealthfront are leveraging their zero-footprint architecture to generate massive free cash flow. They're using algorithms to bypass the traditional friction of banking, expanding from simple cash savings into generational wealth management and automated home lending.
It's two different worlds entirely.
It really is. And this raises an important question, a thought I want to leave you with that extends far beyond the SEC filings we analyze today. Both Zumiez and Wealthfront rely on the exact same core demographic to survive Generation Z and millennials. But these digital natives are fundamentally aging into their prime wealth-building years.
Right, they aren't just teenagers hanging out in the food court anymore. They're buying homes and building portfolios.
And their learned financial behaviors are calcifying. If this generation overwhelmingly demands the zero-friction experience of rent-tap digital stock investing, algorithmic mortgages, and automated wealth management.
Oh, I see where you're going with this.
Yeah, while simultaneously abandoning the traditional physical mall ecosystems for digital experiences, how does the commercial real estate of our physical world survive?
That is a staggering implication for the next decade.
If the foot traffic that brands like Zumiez desperately rely on vanishes, and the massive corner bank branches become obsolete because Wealthfront put a mortgage lender in everyone's pocket, the entire landscape of our cities and suburbs has to be reimagined. The future of wealth might be seamlessly digital, but the physical world still has to pay the rent. Who pays it when the digital natives never leave the house?
That is the multi-trillion-dollar question hanging over the global economy. Thank you for joining us on this deep dive. Keep looking beneath the surface of the headlines, keep questioning the mechanics behind the numbers, and the next time you tap your phone to move your money or walk past an empty storefront, remember the invisible economic webs you are actively participating in. We'll catch you on the next deep dive.